Welcome to Beyond Bacalhau, Cracking the Portuguese Business Code by Raquel Batista. Hi everybody, and welcome to the third episode of Beyond Bacalhau. I hope you really enjoyed the content of the previous two podcasts. As you know, we've had a guest on the previous podcast, and I think the way that I'm going to do this is having a guest over every other episode. So I was thinking about in this episode to really talk about content, and specifically to talk about something that a lot of people ask me about, which is what are the basic charges for a company in Portugal? And these can be really different from what happens in other countries. I mean, every country has corporate income tax and personal income tax. Probably not every country has the same social security system, so that may be different. But essentially, the way that the tax work here in terms of businesses, it's important for anyone who wants to create a business to actually know and be very acquainted with, because it's a fundamental part of knowing how to run a business, because you can't escape taxes. It's like you can't escape death and taxes. It's the two things. So very important to talk about tax. And let's first approach the corporate income tax. In terms of corporate income tax, the current tax rate is 21%. Now, this is December 24, so there is the high probability of it being 20% next year, because this has been discussed for the annual budget of 2025. So let's say that for today, it is still 21%, but with a high likelihood of it being 20%. And what you need to know about taxes when it comes to businesses is that it works a little bit different than it does from personal income tax. So we all pay taxes as personal individuals, and what happens is all the income comes in, you get taxed, and then that's it. So you get taxed on your overall yearly income. Well, it's not the same when it comes to companies, because there's another component to it that makes all the difference. The companies can deduct their costs to their income in order to generate or not profit. And they only get taxed on this profit. Now, as we've said before, private people in personal income tax, we get all the personal income tax into one big bag. We get taxed, and then we have that money to pay for things and to make costs. And there are a few personal income tax deductions that happen all the time, only exclusively for residents. We're talking about education expenses, grocery shopping, car repair, bike repair, veterinarian expenses. So the Portuguese government gives a lot of cost deductions when it comes to certain types of expenses, because it considers that it's for the good of the family. So at the end of the year, you can go and check your invoices in the tax portal. Now, if you want to have invoices in the tax portal, you first have to request an invoice with your NIF. Okay, so nothing is official without an invoice containing your NIF. Okay, your NIF, by the way, is the same as the VAT number. A lot of people ask me that. It's the same thing. Now, when you ask for an invoice with your NIF, the company that you're buying a product from has a system that is integrated with the tax portal, with the tax system. And so they have to have a certified tax software wherein as soon as that invoice is issued, it communicates with the tax authorities. And if you order your invoice with your own NIF, the tax authorities know immediately that you, with that NIF, had that expense at that company or at that store or whatever. And so if you do that, all of your purchases will be listed in that segment of your tax portal. So you can access that if you have your password, and you can see all the purchases that you've done, and you can see if there's any right to any deductions. So if it was a veterinarian, grocery shopping, any of those items that you can deduct expenses. These are deductions that, whether or not you have a company, whether or not you're a freelancer, they're always available for the private, for individuals. Okay. But you do have to be a resident, because these benefits are not available to non-residents. Okay. So this from a personal income tax point of view. And I wanted to give you this difference and this notion, because the personal income tax always exists whether or not you have a business associated with you, whether or not you're an employee of someone. Okay. So in terms of personal income tax, it's very important to realize that it is always that, and it's always going to be the basis of your taxation. Now, everything that you have over that is on top, is an extra thing. Okay. So now, in terms of personal income tax, the tax year corresponds to the civil year. So it's from January until December. Although the tax filing is not in January, the deadlines depend on whether you're a freelancer or not, whether you're an employee. So you have different deadlines for different people. There are people that have automatic IRS, so those are like the first ones. And then at the end of that period, when everybody filed their taxes, then you get a tax bill. It's called liquidação. So that's where you know how much you're going to pay in IRS, or if you're even going to receive a reimbursement because throughout the year you have paid too much tax. Now, how is it that people can receive tax and not pay tax by the end of the year? Well, it's especially easy when you're an employee. When you're an employee, your employer has to make a certain deduction of your tax. So instead of it being a lump sum that at one point at the year you have to pay it all, because the government wants to make sure that you have enough money to pay, it spreads around all the months of the years through installments, let's say, that payment of IRS. And so if you're an employee, you will see in your salary receipt that there's a line of deduction for IRS. All right. And that is a little bit like a tax credit that will allow you at the end of the year to already have given a substantial amount of that tax. Now, it may not be enough because you may have other income coming up that it has to be taxed. But at least when you are an employee, you know that you have those deductions. Okay. So you know that you're not going to pay a lump sum. So when you're an employee, or when you're actually also when you're a freelancer, you will notice that in your salary receipt, there is a little line, no, not that little for some people, but there is a line that says IRS deduction. And that means that every month your employer is delivering an installment of your IRS to the government. And what that also means is that when you get to the month where you have to pay the yearly tax, you've already paid for 12 months, a little bit of that tax. And so when you have to pay, which is around July, August, it may depend on the situation, you know that throughout the year you've been paying a little bit at a time for that tax. So it may happen that you've overpaid, or it may happen that you underpaid. Okay. Although the tax year is from January to December, remember that the tax filing is from April until June, and the tax payment is actually after that. Okay. And another thing, because you're filing your taxes from April to June, you're filing your taxes for the previous year. Okay. So in 2025, you're going to file your taxes for 2024. Okay. from January to December of 2024. And this is a bit different from other countries. So I really want to acknowledge this difference so that you know how to go about this. And it is especially relevant for people that have to pay taxes in two different countries, because of course the timing of the tax payment is very different, and you have to integrate so the payment of the tax that you do here to the payment of the tax that you're going to do in your country. And then remember, there are double taxation treaties. There's a lot of things going on. So you really should have like an expert on your side to see which tax is better to file first, which tax is better to pay first, if it's the Portuguese, if it's the other one from your home country or whatever. So there may be a lot of circumstances that are, that you have to think about when it comes to filing your own personal income tax in Portugal. So be aware of those differences. Talk to someone that can advise you in terms of that tax timing of paying with two different jurisdictions. Okay. So in terms of the tax payment, as I said, whether you're a freelancer or you're an employee, you have started to pay every month a little bit of your tax. And so when it's time to pay, or when it's time to file your taxes, you may have overpaid. Now, how does this happen? You may have overpaid because the amount of your salary is to a certain amount that you have a certain percentage of deduction. But when you file your taxes, you may have so many deductions that you would end up having not to pay that much tax, and in the end. So what happens is that you've overpaid during the year, but then you have education expenses, health expenses, whatever, a lot of expenses that make your tax bill come down. And so when you get to that final figure of the tax that you're supposed to pay, and you compare it to the tax that you've paid throughout the years, sometimes you've overpaid. And so when that happens, the government gives you back that money. And so for a lot of people, the month of June, July can be a great month, because a lot of times when you're an employee, and you have kids, especially if you have more than one kid, there's a lot of deductions that you can do, private schools you can deduct, etc. And so sometimes there's a good surprise in July, and the timing is great, because then in August usually everybody goes on vacation. So I hope that happens to you. Now, it is also possible that you've underpaid. And it is possible because maybe your salary is a relatively low salary, and you have a lot of other income that compounds to your overall personal income. And so if that's the case, and you haven't prepaid in installments every month a little bit of that tax, and this only happens when you're an employee or when you're freelancing. So when there's another entity doing this for you, you can end up having to pay a lot of tax, because let's say you have income from rents, you have income from capital gains, you sold a property, whatever it is. You don't have that possibility of doing those 12 installments. That's going to hit you all at once at that specific time of the year. And if you've underpaid, or if you have specifically when you've sold property and there's a huge capital gain with the difference of those prices, you can have a really big tax bill. There's ways, of course, to make that come down, especially with the capital gains of selling property. That would be like a whole episode on its own. But I just wanted to let you know how it is possible to underpay or overpay taxes in Portugal. And also, so the takeaways: tax year corresponds to the civil year. Filing of the taxes is not in January. It starts in April. The actual payment of the taxes is later on, because the tax authorities have to verify if everything is okay. And sometimes you can overpay and sometimes you can underpay. Okay. When you underpay, you have to then pay your tax at that time. And yes, it is possible to actually, if you have a huge tax bill, to split it up. under certain circumstances, you can ask the tax authorities to split that payment up. Okay. So if that's your case, you really have to connect to your tax office and talk about this. Okay. So that is this bit for the IRS. Now, I wanted to talk about the corporate income tax. The corporate income tax is charged only on profit. And this is the difference between the IRS and the corporate income tax. And that's why I wanted to previously talk a little bit about IRS. So again, when you're taxed on the under the point of view of IRS, you get your income, you get taxed, and then you can spend your money. When you have a company, it's different because you have your income. So the company has clients, the company sells products, whatever it is, the company receives money, it's income. But the company also has costs. And those costs will get deducted to the income to generate profit. One of the huge differences between freelancing and having a company is the fact that when you're freelancing, there's a limit to the deductions that you can make in terms of costs. There's no such limit when you have a company. In fact, you can have a given year where you have a loss. And a loss means that you had more cost than income. And so you didn't have any profit at all. You've had a negative profit or a negative result. And in that sense, in those circumstances, there is still the possibility of having to pay taxes because of certain expenses. But in essence, theoretically, you're only going to pay corporate income tax if there's a profit. And this is essential to realize because having a company, it is essential to know how to benefit from the system. It's really essential, key to know what you can and what you cannot do in terms of expenses to be borne by the company and how you can optimize to the fullest extent the fact that you have a company and that you have a business to run. Okay. With corporate income tax, the same thing happens a little bit as how it happens with the IRS, which is the government, instead of just waiting for once a year for you to pay a lump sum, it goes and asks you for, 4 installments or whatever along the year. Okay. So that it has more assurance, it has more guarantee that when the time comes that you have to pay the yearly tax, you've at least already paid something. And so, the chance of you making that bill happen is bigger. And so there's a similar thing, which is called pagamento por conta. So it's like little installments of corporate income tax throughout the year that also can be done. Think about income coming in and think about the costs. Now, the income is very, easy to understand. You invoice your clients and you get that income. The difficult part is sometimes with the cost, because not a lot of people know what kind of costs should be inputted to the company. Now, it really depends on the type of business for some types of expenses. And with other types of expenses, no matter what the activity of that company, there's still a no-no or there's still a very good cost to have. Okay. So let's say business related costs that you have. These are costs that you have in order to maintain the business operating. Now, if you're renting an office, you're buying a computer, you're paying internet bills, you're paying, whatever it is that you need, materials to make that business keep running. If it's a restaurant, grocery shopping, whatever it is, those are the costs that you need to pay through the company, of course, because those are exclusively business related costs. Then you have a certain type of cost that a lot of people, have to wonder, can I put this through the company? Can I not put this through the company? And sometimes it depends. For instance, a lot of people think that they can deduct all their house expenses if their company's headquarters is their house. You cannot, people, okay? This is not the way that it works, because although you do have your business in your address, you also live there. So not every expense that you're going to make with that house or that apartment or that home is going to be business related. So please don't think that just because the headquarters of your company is your own address that you can go and have your electricity bill and water bill and internet bill and all the bills related to that property going to the business, because that's not how it works. And if you're renting, it's the same thing. So if you're renting for the personal use and you actually use a bit of that house for the business, you cannot deduct 100% of that rent, because the reality is that yes, you work there, but you also live there. Okay. So as I always say, when you come from a place of truth, it's very difficult to attack you. And so if you know as a concept that yes, you work there, but also you live there and you have other people living there that have nothing to do with their business, you can understand that not all of the expenses can be appointed to your business. The costs there that people have more doubts with are these types of things. If the headquarters is the address of the company, what kind of costs can I put? Now, I would say that any cost that is exclusively related to office or your business can be deducted. Let's say sheets, because you need to print things, a printer, toners, computers, all of that you really only use for your business, or specific tools like softwares or microphones or whatever it is that you only really use for your business, that can of course be supported by your business. But you cannot go out shopping and buy a dress or a suit with your company's credit card or card just because. That is possible if by any chance you're a designer, or you're, I don't know, a model, or you're a tailor, you're in some type of industry where that is something that comes with a business. But you have to understand that it has to have a complete connection with the activity that you're in. Okay. So if you're a hairdresser, of course, when you're buying shampoos, you're buying stuff for your hair, all of those are deductible to your company, because that's what the company does. But it's not if you're not a hairdresser. So you cannot write off a shampoo expense just because you have a company. Okay. So be very mindful that it really depends on the type of activity that you're going to have regarding certain expenses that you can put through the company. And look, I have a great example. I have clients. I have a couple of clients that they're artists. I have a couple of DJs. I have a couple of performers. And in those cases, they have to have certain suits. They have to buy certain types of clothes. And of course, that those expenses are for sure completely related to their business, because they're not they're not dressed like that in their everyday life. They're only in those costumes or whatever when they're doing their business. So as you can see, there is the possibility of certain expenses that, in principle, you wouldn't consider that could be borne by the company. In certain circumstances, of course, they are. So take into account the specific activity of your company. So income minus costs. Again, there's no limits to the cost deductions. There are certain costs that cannot be deducted 100%. Let's say you buy a car is not deducted 100% in that year. It's split in 4 years, so 25% on the first year, 25% on the second year, and so on. These are accounting things, so I would suggest to really talk to your accountant and ask him about the specific costs that you can make and how they spread out around along the years. Okay, because that is going to make a difference when it comes to the final profit that has to be taxed. Maybe you bought a car and you think, I fully deduct that amount. I'm not expecting to pay any tax because I don't have a profit. And it turns out that you do have a profit, because only 25% of that expense is counted for that. Same as property. The amount of a property is not written off on the year 100%. Okay. So really advise yourself when it comes to specific expenses and how they are accounted for in the filing of those taxes. Okay. So again, income, costs, and then profit. Okay. Only the profit is taxed. So by the end of the year, if you've had more income than costs, you have profit. And that is the only thing that gets taxed. So you see the difference between IRS and corporate income tax, because you only get taxed right at the end of it. So after you've paid all the costs. In personal income tax, it's the reverse. So in personal income tax, it's the complete reverse. You have income, you pay tax, and then you have your costs. Okay, so that is something to take into account, and something that is very different when you have a company. Okay. Another thing that a lot of people ask me about is dividends, and people just assume, oh, okay, so I want to take money out of the company, I'll take dividends. Well, it's not that easy, because for you to have dividends, first of all, you have to have had profit. Okay. Dividends is the money that's left after paying taxes. So after income minus costs, and then you have your profit, and then you were taxed, and whatever's left of that is the money that the company has. It's already been taxed. It's not going to be taxed twice. And the shareholders may decide in certain circumstances that they want to take out that money from the company. And that is called dividends. So it's the payment of the profit after taxes that is paid to shareholders. Now, and you can only do this if you've had profit, and if that profit was taxed, and if there was anything left after this. Okay. When the company pays dividends to its shareholders, it's important to realize that that income then enters your personal income sphere. And as such, it is going to pay capital gains. It may in certain jurisdictions be exempt, but in principle, because you're taking money out of the company and the company already paid taxes, you think, oh no, this money is tax free. No, it's not, because it's entering as income to your personal sphere. Okay. And you are going to pay personal income tax on dividends that you collect from the company. Okay. Because that's money from the company. But then, because it gets into your personal sphere, financial sphere, it is a capital gain. Okay, so very important to take that in mind. Now, to really talk about another important charge is VAT. And a lot of people don't really understand how the VAT works. The VAT is a tax that is charged to the final consumer. Okay. It has different rates. It can be 6, 13, or 23%. It depends on the type of product, but it's a tax that is charged to the final customer, to the final person that buys your product. Okay. So the companies, when they sell their products, they're selling their products to their clients, and they're doing that. They're selling to their final client. So the company issues an invoice for the sale of that product. And in that invoice, you have to have, if there's no exemptions, etc., you have to have a line that says VAT. Now, that VAT part is not income of the company. That VAT part is the money that the final customer is going to pay the company, and that the company has to deliver to the tax authorities. And so that's why in most cases, when we're talking about businesses and operations and quotes, we say it's an X amount of money plus VAT, because the VAT is not for the business. The VAT, it's actually to deliver to the tax authorities. It's not the companies. So be very mindful that when you're receiving the money from an invoice, that those 23% are not yours, companies, to spend. And I cannot stress this enough, because you don't pay that VAT immediately as you receive it. And so there's a difference in time between receiving that VAT and having to pay that VAT to the tax authorities. And I cannot tell you how many times, in how many cases, because there's this difference in time, people get completely lost. And when it's time, by the time the VAT bill comes along, they have no money to pay that. Okay. So have like control file, a control Excel sheet, whatever, organize however you can, but make sure that that percentage of VAT that you charge your client, you don't do anything with it. Okay. It's there, have a second bank account or have a really nice control Excel spreadsheet of some sort. Okay. Now, what happens with the VAT is that companies, because they charge VAT, but they're also the final consumer of some goods, let's say a computer. When a company buys a computer, they're also paying the company that sells them the computer those 23% in VAT. And what happens is that companies can deduct the VAT that they pay for the goods that they need with the money that is from the VAT of the clients that they have to deliver to the tax authorities. Okay, so there's the possibility of deducting the VAT that you as a company, as a final customer, had to pay from the VAT that you received from your final clients and that you have to deliver to the tax authorities. And this is where a lot of companies get into trouble because first of all, they think that VAT is their income. It's not. And so when a VAT bill comes along, say, oh my God, I can't believe I have to pay this VAT bill. Yes, you have to pay that VAT bill. It's not even a bill. You've collected money that is not your own, and you're obligated to give that to another authority. So it's not even yours. You can't even conceptualize this income as yours. Okay, so please set aside, forget about those 23%, forget about its existence, because when the time comes to pay, you'll have to deliver the 23% that you collected from your clients. If you have expenses that you can deduct, great. Then that means that the VAT amount that you have to deliver to the tax authorities is going to come down. And in the end, let's say you net both positions, let's say you've deducted as much VAT as you had to deliver, that means that in the end, you won't have any VAT to deliver. And this is huge because it means that the company, your business, actually didn't pay VAT when the company bought all your assets, okay? Because they were deducted from the VAT that you had to deliver to the government or to the tax authorities. So final take on VAT, it's not yours. It is not yours, okay? Set it aside, forget about its existence, and you'll have a great surprise if you do forget about it, because if there are any expenses that can be VAT deductible, then you have a lesser amount to deliver to the tax authorities than you would have thought. And so you get, at the end, you get that extra money, and you're authorized to put it again to use of the company. But other than that, forget about it. Okay. This is the way that the VAT works in general. It can be paid every 3 months. It can be paid monthly. It depends on the company, on the timing of the company, on certain circumstances. It even depends on the specific company, because there are certain activities that have either tax benefits, so their VAT rate is a little bit different, but there's a whole lot of specifics that you have to take into account. And so again, I cannot stress this enough. Please go to your accountant and ask them specifically what your case is and how you can go about this. Okay. So we've covered IRS, we've covered IRC, which is the corporate income tax, and the VAT. There is one other cost or charged for the company that I'd really like to approach. And it's specifically very unusual for people coming from other countries, the fact that it's such a huge bill. And I am talking about Social Security. Social Security in Portugal, it's a huge bill, okay? It's 34.75%, okay? And just to give you an idea, if you have an employee, that employee is going to pay 11% of that, okay? And the company has the 24 something that's left. But 30 something percent, it's a huge cost in terms of company, okay? And if you're a company, you have to have management. And at least that management is going to pay Social Security because they're working for the company. And so there are employees in some way of that company. And in that regard, they are going to have to pay Social Security because they're employees, they're managers, they work for the companies. You cannot have a company without a manager. It's like a body with no brain. Okay. So even if you're a shareholder, and there's no one else to work, it means that you're a shareholder and you're a manager. Okay. Now, in certain circumstances, even if you don't take out a salary, even if you decide that you're not going to pay yourself a salary, you'll still have to pay Social Security because the tax authorities in Portugal always want people to pay Social Security. So there are international agreements in terms of Social Security, whereas if someone is paying Social Security because they're employed elsewhere in the world and they're paying Social Security there for that salary, they don't need to pay Social Security in Portugal. They're exempt because they're already paying somewhere. But this, for instance, is not available to people from the US, from Canada, from South Africa, so don't think that just because you're paying Social Security somewhere else, that means that you get exemption in Portugal. Not at all. If there is no international agreement in terms of Social Security, even if you're paying in your home country because you have some sort of employee income there, you will still have to pay Social Security here, okay? And that is one of the fixed costs of the company. So aside from the accountant, and we'll make a specific episode on that. But aside from the accountant, the Social Security is definitely one of your fixed costs because at the very least, you have to have one manager, and that manager will pay Social Security unless that person is already paying Social Security somewhere in the world where there's an international agreement with Portugal. Or for instance, if you're an employee in a Portuguese company and then you have your business, you can choose to not take a salary out of your own company. And because you're already paying Social Security as an employee in another company, you don't have to pay Social Security in your own company. What you need to think about is you have to pay somewhere. If you're not paying anywhere else, you are going to pay in your company as a manager, okay? And again, it is a huge cost. It's 35% people. So it is a huge cost. That's one of the major charges that you have to take into account when you have a business, because it's going to be one of your fixed costs. And if you have employees, it's certainly going to be one of the biggest bills that you have to pay. What the hell is Social Security for? A lot of people ask me. Well, it's not health related. A lot of people think it's because it's similar to health insurance. It's not. It has nothing to do with health insurance. So what the hell is Social Security for? A lot of people ask me. Well, it's not to pay health expenses. A lot of people confuse and think that it's some sort of health insurance. It's not. It has nothing to do with that. It's not health related. It's a charge that has as an objective to pay certain amounts that are considered needed in terms of a social country. And I mean maternity leaves, sick leaves, unemployment help, and also, of course, then your pension. So you contribute every year while you're working to Social Security, and in the end, when you retire, you get the right to a certain pension. Okay, so that is what Social Security is for. It's not health related. The SNS number, which is the National Health System number, it's a completely different thing. Social security number, it's called NISS, so it's NIS, and a social security ID number, so it's different from your NIF. And you are going to have to apply for that if you're going to have a company and be a manager, or if you're going to be an employee in some company. Okay, so summing up, we've talked about personal income tax, corporate income tax, VAT, and social security. Okay, these are the four basic charges that you have to be very aware of when you have a company. And I hope this was useful content. I certainly thought about a lot of questions that my clients ask me in my consultations. And I hope this content helps you to really integrate the thought of having a business and what it takes to have a business, and to take into account that it is going to have bills that they have to pay. Okay. Thank you so much for watching. Please subscribe. Please follow me on socials. And until next time. Mwah.